Hey everybody, welcome. My name is Matthew. Thank you very much for joining. Today is a continuation from my last video. We're going to look at another trend line for the S&P 500 index. So here we have again the S&P 500 index over 223 years or thereabouts. And again, you can see generally, I talked about this in my last video, it's much more shallow, much less steep of a curve to growth here until somewhere around here in the 60s, let's say, certainly into the 70s and 80s and 90s and 2000s. Even though there are plenty of booms and busts here, you can see that the growth on log scale, remember this is log scale, is still steeper at this point. Okay, so I'm going to put the all-time trend line on again. And again, this can still be volatile. This is over 220 years, so you could go decades without actually crossing the trend line, as you see. But you can be right on it, as before the Great Depression. You can fall down to like 15% of it here. See the S&P was about 6. The trend was 30. You can be 4 or 5x above it at the .com top. We didn't even hit it, the all-time trend, during the 2008 crisis. And then now we're back up to 5, 6, 6x, almost closer to 7 even. 7 times higher than the all-time trend. So the structure is clearly different here than it has been over the first 180 years or so, let's say, of the country basically, and of this index. Again, a gentleman, Nick Laird, Australian, good guy, has back calculated this before the S&P started in the 1920s. All right, so this is the all-time trend. But what I wanted to show you in this video today, just a little follow-up, is let's do a trend line only from here. You could pick somewhere in the 50s and the 60s. It's not going to be much different, actually. But I picked actually 1971 because on that date, major change in the monetary system happened. We went on a pure fiat standard, last vestige of the gold standard. For those gold bugs know, is August 1971. So let's see what happens from here on out till today. Let's just draw same exponential trend line and see how it looks. All right, so this is in blue. Now, much steeper. You can start to see the steepness of the market is obviously is stronger here, and it's just growing faster since the 70s than it was all time. Okay, and there's a couple ways you can think about this. I'm not going to provide all the answers in the video, but let's just again give you a number. So the all-time trend line, the slope of that curve, remember exponential trend lines are straight lines on log scale, which we have. The trend line moves at a compound annual growth rate of 3.4%, the all-time trend line, the black trend line. This line, all right, let's zoom in a little bit so you can start to see the differences here. This line from 1971, the 1971 trend, that grows at a compound annual growth rate of 8.2%. All right. So that's a big difference. 3.4% on the black line year after year, whereas if you take the 1971 trend, your money, your return will double basically twice as fast, 8.2% per year. All right, so that's actually faster than doubling every 10 years. Every 10 years, a doubling would be 7.2%. I don't have the exact numbers on how quick it doubles at 8.2%, but basically it will double at twice the rate of the all-time trend, if you catch me there. So 8.2% for the blue line versus 3.4% for the black line. So a few things we can determine from this. Basically, staying invested in stocks will give you an indication of, one, how good the market is doing, okay. But number two, it could give you an indication as well of how poorly the currency is doing. They're not fully independent of one another. They're certainly related. There's overlaps. I can't tell you for sure this is just the currency doing poor, of course, because we've had a lot of technology during this era as well. And that certainly would add to the slope of this curve. the internet itself. This is why something like the CPI index, I'm not a fan of measuring the CPI index over, whatever was happening here 200 years ago versus now, because technology is a major, major factor there. So I like to use different proxies. For example, the stock market. All right, so again, 3.4% per year is the black line. This is moving at 8.2%, the blue line. Let's zoom in again, and let's put those 2 sigma bands, all right? 2.5 percentile on the bottom, a 97.5 percentile on the top. What that means is basically 95% of the time, based on this trend line from 1971, the stock market is going to be in between these bands. And if you remember from the last video, those bands were much wider over 200 years. I don't have them on this video, but they were much wider. Here, they're much more constrained. They're much narrower. And that's actually interesting. There's more confidence as time goes on that the stock market is moving in this trajectory. Now, will it always? That's, of course, the billion, trillion dollar question. I don't know the answer to that. I can't tell you, but I can tell you statistically how it looks. It is growing faster, no doubt, 8.2% per year, the blue line and the red standard deviation bands, as opposed to that black line, which is only moving at 3.4% per year. So the rate of growth is double the blue and the red lines. They're double the rate of growth than the black line. That's quite interesting. More than double, of course. I'm just being very, very rough here. All right, so again, now we can see 2 standard deviations to the top. The dot-com boom before the bust. Actually, the dot-com bust at that time doesn't look so bad, because the Greenspan, the maestro, as he was called by the New York Times, dropped interest rates to then historical lows, about 1%, between 1 and 2%. During this period, which was just the insane period, the subprime period. Everybody thought they were rich on real estate period. And then, of course, we didn't even get as high, or about as high, I should say, as the Dow, as the S&P in 2000. In 2008, then we took the big plummet. And here we did fall below the 2 sigma down move. So very, very rare air to the downside based on the 1971 trend only, mind, well above the all-time trend. All right. And we started to grow again. Okay, to where we are today, really right on trend, smack dab on trend. We can zoom in even more. I mean, as of December 2023, trend is 4,569 on the S&P. The index itself is 4,769. So right on smack dab on trend. That's interesting. All right, and I figured I should give you this additional context, because the bird's eye, of course, is also very interesting to see, but when you zoom into sort of what's been happening over the last few decades, you also get a different picture. Again, I am not saying that we continue on this trend. I don't know. Everybody who follows me knows that I'm much more conservative, hard asset type fellow. But looking at how the S&P has done over the last 50 years, when we've been completely off the gold standard, it has risen, the trend itself, at 8.2% compounded annually. All right. So that is a pretty strong rate. And if we extrapolate that out until 2030, we're going to have the 1971 trend put us at 7,900 on the S&P. And the all-time trend, remember taking all that data all the way back to 1800, that only predicts an 892 S&P value. And of course, we've been above that for 40 years. So these are the interesting things, I think, to look at. Yes, the market structure, technology has, of course, changed in the last 40, 50 years. And that is more accurately reflected in the trend line in blue and red that I've drawn here. But you never know, okay? It's beyond the scope of this video to talk about the strength of the currency, but there clearly is going to be a devaluation of the currency when you have things like the Greenspan put, the Bernanke put, the Yellen put, whatever it may be, where once the markets start to show some weakness, they're just going to add liquidity, add fresh reserves, lower interest rates to keep that speculative bubble rising again, that Keynesian sort of always keep us in the semi-boom rather than suffer the pain of the bust. Could be a tough cocktail pill to swallow at certain times, as it was here in 2008. And, interest rates, I shouldn't get too much on interest rates. That's not the point of this video. The point of this video is to show you at the moment, yes, when you have invested in stocks in the last 50 years, you're going to get an 8.2% return according to the trend compounded, whereas the all-time trend is much lower, only 3.4% per year. And in addition, think about this. Those numbers that I just gave you, unlike the penultimate video, those numbers I just gave you right here are without dividends reinvested. So if you reinvested those dividends, these returns would be even higher. Food for thought on where the stock market has been over the last 50 years. Hope it helps. Thanks.